technical skills is, I would be sort of included in that line. So hopefully it'll be as simple as pushing the down button. Can everyone hear me okay? Somebody nod their head that's got their camera on. Okay, good. Thank you. Um, there's a variety of people that are on the call that Raja had walked me through. I've got a kind of a generic presentation that sort of kind of talks about what, my background is, what my skill sets are, how we frame up and look ideas from a venture capital perspective. But clearly in that first 30 minutes, I'll go through and frame it up. And then the next 30 minutes is clearly open to go any direction that anybody wants on any topic. I mean, this is your time and I'm happy to do that. Two other things that I'll offer up to the people that are on the call. First is if you'd like a copy of the slides between Raja and I, we can send them to you later on by email. No problem if you just would like to have the slides. And secondarily, everybody's got a sort of a different, might have a different reason for wanting to learn more about this. And if you want to do a deeper dive in your own particular situation, I would offer up those that have been involved with me for a long time knows there's a woman named Shannon Morin, Morin, and her phone number is 484-241-2645. And the code is Michael have a meeting with me. And I'd be happy to follow up on anybody's sort of specifics around early stage financing if you want. Give you an hour that way. I have the time now, so happy to do that. So let me just blow through the presentation here so that we can get on to your Q&A, more importantly. I'm an entrepreneur, no doubt about it. The data completely supports that, but I've sat on a lot of different sides of the table. I'm a financially oriented entrepreneur that funds early stage, high risk technology deals. I mean, that's kind of, if I was doing the elevator pitch about who I am, that's kind of how I've evolved and it couldn't have told me 30 years ago that I had any of those skill sets, but that's clearly in terms of my random journey is what it's turned out to be. I've also been on a bank board. I was on KMBT's bank board for over 10 years and on the loan committee there, and I was the audit chair. So not only did I see sort of funding tech companies from both sides with capital, I also saw the lending side as well. The next slide is if you ever raise money, you have to legally put in pages and pages of what's called risk factors. And I'm just going to list them here. And the thing about it is that for any business, there's no guarantee. The disclaimer is that you will ever be successful, but if you don't try, then you'll never know. The stats are dated, but at one time I had stats when we started our business. It said, only 1 out of every 100 businesses that start every year make it through a year. And out of that 100, or the 1 out of that 100 that made it for the year, only one of those ever gets to $1 million in revenues. So, you say 1% of 1%, the likelihood of success of building a successful business, whatever success is defined as, is not trivial and it's hard to do. And the expectation is, from my perspective, which is interesting if you're out to raise money for your idea, is people have to begin to understand from the beginning they could and probably will lose all their money, but they're placing a bet on a number of variables that you have to be able to sell them on, and we'll get into those later on. But the reality of, especially the early stage investing, it's not for the faint of heart. For me, why, looking back retrospectively, I'm 62 years old now. I moved to the Lehigh Valley when I was 29, single and clueless, to join three other guys at the time to start a business up at the Ben Franklin Incubator. 1987, 88 would have been 18% interest rates. That would have been last 2 days ago when we had the largest stock market crash in the history of the Dow, they said. They compared it to the drop in 1987. Well, I quit my job in 1987 to start the company with my friends. And I went public during the dot-com era and lived through the crash. We raised money for a venture fund when the real estate market crashed in 2008. So to me, other than the newness of this coronavirus, which is a new variable in massive stock market crashes, This is my sort of fourth catastrophic life event that the Dow now has milestone events over the last 35 years. So it just adds up to be another risk factor with early stage companies that you just have to deal with. So why particularly did people trust me with their money? You might be the nicest person and you're trustworthy, but if you don't get results, people invest with you once, but they'll never do it again. I've been fortunate enough, and these are marathons. None of these were sprints or quick money on anything that we've ever done. You can see that in 1987, as I mentioned, through 2004, with my two business partners, we took the idea of a sunscreen product on a towelette delivery system and exited with an oral fluid HIV test. And in the meantime, put over 200 jobs in the Valley. And, the rest of our story when we walked out the door was a public company with a market value of $255 million. Our original investors invested on a $3 million valuation on the idea of a sunscreen product on a towelette, and they exited with an oral fluid HIV test at the peak of the dot-com market. So fast forward, one of the things I'm most proud about is, we built businesses that, weren't quick hits that left. You fast forward and Orsher, which was founded, a predecessor company in 1987. If you fast forward to 2019, Orsher had over 154 million in revenues with 472 employees. So the sustainability of that business on the south side of Bethlehem has been terrific. So after, I retired or got run out or wanted somebody that shaved every day and like I didn't and didn't want dogs in the office, whichever, permutation you want, I left and retired in 2004, took 2 years off, didn't quite know what I was going to do next. And then ended up co-founding and starting a venture capital fund, which we called Originate Ventures. We raised $46 million, went out to raise, I think we went out to raise $15 million and ultimately raised $46 million. Have a lot of local investors, 129 to be specific, with a minimum investment of $100,000. I'll have a chart later that sort of shows the mix of investors we have. And we made 17 bets over the last, essentially 11 years. The good news is, looking backwards now, because we're near the end of the life, is we still have 4 portfolio companies left, but we've returned over 3x the invested capital. And the part of my presentation literally is the thesis about venture investing, because that's kind of been my sweet spot. Going forward, I don't like to say I'm unemployed or retired. So if you go to One Putt Ventures, that's Mike Gausling reinventing himself to go forward. I've done 2 passive deals here. I'm not actively looking for anything, but I've, actually sort of last year did, if you add the math here, $18 million in financing that I put together in one way or another, just kind of leading on my own with the network of people that I had while I try to putz around playing golf more often. So why people trust me with their money? And this is just a laundry list, but I think that ultimately people bet on people. You got to have your fundamentals right, and you got to frame it up, and you got to have a strategy, and you got to have a plan that's financially viable. But people bet on people, and I always heard for the longest time, Mike, you're so excited about what you do. Your passion for what you do is contagious, and I want to be part of that. And I'd go, okay. I was kind of clueless that was, that the passion was as high as it was, because it's just the way we were. But I heard that over and over and over again. Anybody that knows me knows that any question I get asked, they'll end up having a variation of some kind of metrics that I'll immediately put on it, because I'm financially oriented. I just frame up everything mathematically, and I only need a single data point to call it a trend line, and then you just kind of make it up from there. Ultimately, you want to bet on what people think are great ideas. Open book communications has all been important to me. I am clearly of old school that says that you don't pay executives, especially early stage, you don't pay them like pigs, and you pay them like owners, and you pay them like it's an equity play. So I've always been in the camp that that compensation among all employees is very low, but you let everybody be in on the equity play. I have, I'm almost a fossil with that concept, but especially with early stage companies, as soon as you start paying yourself what's defined as fair market value for your leadership team in an early stage, you're going to run out of money before you actually get anywhere most of the time. But that varies by company, and we've clearly seen some of those issues with our early stage venture fund deals with experienced people that have mortgages and kids in college. Ultimately delivering good results and giving back to the community. But in retrospect, this is a laundry list, but these are kind of the top reasons I think that people trusted me to give me a whole lot of capital over the years. The other thing for me is my core values. I sort of find, that they've evolved. A trust, agility, innovation, and quality were our 4 core values at OraSure. Mine, trust, transparency, and results. And the definitions of these are important. Deliver total quality, solve problems quickly, and resolve issues equitably. If you're involved with a startup, no sooner do you write the plan than it's not even worth the paper you wrote it on, because something happens and you have to be agile and change things around. And you got to be able to live with the current factors that are around you. The world has changed in the last 2 weeks in ways I've never seen it change with this coronavirus. That is resolving issues equitably under the guise of coronavirus. That is the new variable that any entrepreneur or any business owner has to be able to do. And you earn trust right now as you resolve a pandemic in an equitable way while trying to still keep your business alive and running, but have the safety of you, your family, your employees, and whether it's your patients, your customers, your clients, your friends, keenly, in the middle of things. So when I look at core values, resolving issues equitably has to do with sort of situationally, are you really sort of, adapting to when you need to be. Transparency, good, bad, or ugly. I have very little gray matter. What you see is what you get. And if I say no and you convince me differently, I'll happily go to yes, because I'll tell you why I was a no. And you just got to be open book. I thought everybody was, and find out in the world of sort of disclosure, both from being on a bank board and having 17 portfolio companies and looking at the work we put out. I guess we've always been, unbeknownst to me, sort of best in class, world class in terms of transparency of financial data and the analytics we put around that in terms of summary letters and things. And I just think it's crucial that people do that. Results, I'm a results guy. I mean, ultimately, I let investors down if we don't perform, and I can't live with myself going in with that idea. So you manage it as best you can. No guarantees in life, but that's an important variable to me. So now I'm just going to blow through some specifics around the venture fund that we started, so you get a handle for it. Just to do a visual for those of you that have been around here a long time. That's the building. That's OraSure is right behind it. This used to be Bethlehem Steel's #1 firehouse. I tried to buy it a couple times when we were at OraSure as we were expanding and needed our footprint increased. And Mark wouldn't sell it, but I bought it. And then in 2008, I transformed it to what looks like the Victory Firehouse now. This is the most financially irresponsible project I've ever done in my life, knowingly. I've made a handful of bets personally and, with the fund and with OraSure that we made that we thought would be good ideas. It didn't work out. But this one was, I wanted to be on the south side of Bethlehem. This was an anchoring corner at a time when nothing was going on. We ran our venture fund out of there, invested $42 million, and you'll see the results that we had in a minute. Now there's a medical device company in there called Cryo Concepts that was founded by Sam and Ned Bala, and Bill Hinchy's there now, and they were the other 2 co-founders of OraSure with me. They're tracking to, be well north of 10 million in revenue, making medical devices out of the building now. So we have repurposed an abandoned building in a really cool way, and that's part of the mix for me as well. For us, in terms of our investment thesis, you can see we did early stage companies. The range of investment was $500,000 to $4 million. And we were the first institutional investors. We had three partners. One was a dear friend of mine that I met at Procter and Gamble. He was a branding guy. He went to Chicago, developed a company called Envision, sold it to McKinsey. And everything about that had to do with him having a deep understanding of how to build and create a premium brand. Glenn Bresner joined us 1 year after we put the fund together, and that was a blessing every which way. We didn't know Glenn was going to be part of the team. He had been with Fred Best, and they had a great run as venture capitalists, and there was a transition point where Fred wanted to retire and Glenn wanted to go on. And we were fortunate enough to have Glenn join us, and he had extensive venture experience and an amazing network of contacts that Eric or I, neither one had from any of our previous lives. Eric lived in Chicago. And, and I've with my two partners at OraSure, we had built a company from scratch to, the numbers we had shown before. So I had plenty of operational financial experience. We had some brand equity, and we had venture capital investing experience. All three of us had to say yes to invest in a company. All three of us have to say yes to put more money into a company. There's been some interesting, conversations behind closed doors sometimes when you have to decide whether to put more money in or, what you need to do during stressful times, but we've always gotten through it fine, and they've been two great guys to work with. This was our sweet spot. Family and friends and angels, individual angels is where most money comes from startups. I have personally, for OraSure, most of the money that I raised was, I did 4 rounds of angel investors in the Lehigh Valley when we did OraSure, and then we did a venture round. So I have personally since 1988 been raising money from angels in the Valley, and probably during the OraSure time, north of $15 million of angel money in the Valley. So that's just been something I've stumbled on to be my sweet spot, is somewhere between angels and institutional. But we wanted to sort of get this space that we just didn't think anybody else was competing. Ultimately, we had 129 investors, what you can see here, the 46.2 million of capital that we raised. State of Pennsylvania had a matching program for startup venture funds, unbeknownst to me. And they do a $1 match for every $3 that you raised. Excuse me. So the state was a big supporter. PPNL's pension fund came in. My two partners and I, we put up $5 million, 5.4 million of our own money. And then the rest of the investors, which you can see is the greatest number, the average was probably 125,000 for the balance of the investors that would have been like 124 angel investors. So we ended up calling 95% of our capital starting in 2008. When you talk about early stage companies, in 2008 was kind of post the real estate crash. And so markets completely tightened up. Capital wasn't available, and we had money to invest. And we had our presentation to our investors, and we said in 2008, we saw over 1,000 companies, met with 200 in a direct dialogue, did more work on 50, and then ultimately only did 2 deals. So the funnel was hard to put financing together for our venture deals, and that's kind of what it looked like. So back to, not only is it difficult to, once you have money, to succeed in the early stage tech world, it's hard to get money. And for us, there were 4 criteria that were important to us. We wanted a compelling idea that was financially attractive with a good leadership team that had what we, in our definition of distribution leverage, was a term called early adopter. Who in the business that would be buying your product says, what a great idea, I'll take the risk, I'll be first to try the product because this will change and be a game changer for me, or will improve the efficiency of something in my business model. We always like to have that somebody had validated it besides just what felt like a good idea on the far left side. And obviously you had to have a financially attractive business model for us to even consider it. And we ultimately, our venture fund probably had on average gross margins in the 75 to 80% range for the portfolio level that we did. So there was a huge bias to those kind of companies. Ironically, and what I find fascinating, I wouldn't have known this, we invested $44 million in total in 17 companies, which you'll see in this chart. we had to put additional money of $25 million into those same 17 companies. And, you know, it's like you put your first tranche of capital in, and then you kind of put little bits in it at a time. The idea that it takes twice as long and twice as much money, you can see by this chart that we put way more money in the 17 bets over, you know, the last 10 years than we did, you know, when we made the bet. I would never have guessed it was a 5-to-1 ratio of old to new, new monies in those existing companies. But this just sort of real profoundly says for an early stage company how you need to have somebody where you can continue to access capital. This isn't, you know, this is one of those kind of proud charts, but you know, the markets have been very robust the last couple of years. 2000, I considered it the period of, you know, irrational exuberance when we went public in terms of the valuation. And then we got the wake up call, you know, 2001, 2002 with the stock market crash. Irrational exuberance, you know, came into irrational, you know, drinking, I think, for, you know, or disturbing feelings, and definitely grumpy investors. But this last period, the last 2 years, I think it's been as frothy in 15 through 18 as I ever saw in the early 2000s during the peak of the dot-com. I've been holding my breath that this market was going to do a massive adjustment because it wasn't rational to me on the private equity side. I mean, there's been a ton of money sitting on the side of the lines. And if you really got a good company that has really good, compelling financials, there's been exits that with private money that wouldn't have existed back in the days when you could only go public years ago. What's the outcome of that? That we've taken $142.5 million off the table for our investors on $44 million of invested capital. And almost all of that, you can see, we had less than $20 million in 2015 that we had taken off the table. It looked like we were going to lose half our investors' money, you know, going into year 8 of the investment. And then we, you know, just the rocket ship finally took off, and you know, we've had a good return. But it's been a long journey. And you know, one of the charts, which is a nasty one, you know, we started the fund in 07, and this is internal rate of return, and you post these in your financial statements in footnotes every year. You know what? How it was to have a meeting in 2009 and have placed about 5 bets at that point, and 2 of them have already gone belly up. And you tell investors who've given you about 30 cents on the dollar of their money so far, you got a tracking at a negative 60% return on your money, i.e., we're losing it all. But trust us, it'll get better. And oh, by the way, we're going to do a capital call for 10% more of your money. So fortunately, we had an exit in 2011. We put $2 million in, took $12 million off the table. That fixed this line. And then we sort of just kind of, you know, teetered along for what you can see from 11 to 15, almost along the line of calling break even. Then it looks like you'll get your money back, but not any other return. And although this is not as steep as the other side, to end up where, you know, through 2019, we've got a compounded annual return since 2007. So call it 12 years of an annualized return of 18.16%. That's pretty cool. So what's next? You know, I said I'm going to reinvent myself as one putt. You know, as most people know, I became a widower 4 years ago. That weirdly, sadly changed my life forever. You know, last couple of years, the fund and other things have been, you know, clearly, you know, great things to spend my time at and do. But as I move in towards more of a retirement mode, that I do one-off deals by myself, One Putt, if you go there, you'll sort of see what I think I want to do with my life kind of going forward. And it makes for good golf ball logos too. So with that, I went right at 30 minutes. I want Raja to help me understand what questions the group has out there. If anybody's still there, I at least can see Diane's face, no other faces. So anyway, I'm going to open up for questions.
So, Mike, we have 34 participants. So let me see. I think we got a first question here coming up. So can you repeat your contact information, please?
Yes. Reach out to Shannon Morin, Morin, and it's Shannon.Morin@originateventures.com, or her cell phone or her work number is 484-241-2645.
Okay, so I want to pose a question to you as I'm checking the chats here. So in our 1 million cups, we have well, majority of our presenters on a week-to-week basis are what I would call our micro businesses. They are either retail oriented or in some cases tech oriented, service oriented. Some of them are already have an existing business, probably anywhere from, let's say, 1 to 10 employees. In some cases, it's a pure startup ideas. So can you give some feedback as far as how to go about when it comes to funding and financing? Because one of the things that I see when I'm listening to presentations and sometimes question is that there is a disconnect versus what the reality is and versus what they should be really looking at. So can you give them a couple of pointers on how would you approach it?
Well, it all depends a little bit on what a person's age is. We've had students here, and the programs you're doing about entrepreneurship, to sort of get students and people to sort of understand a framework on how to start a business. I think that whether it's CACLV's, how to start a business where there's a framework, a template that's been trained on. I think that entrepreneurs have to be able to use templates and that are already in place to really frame up their business in the form of a business plan and strategy long before they sort of start to come asking for money. Because if they can't quickly answer the most basic questions in a thoughtful way with confidence, they're not going to get any money. And so I think it's imperative that programs like you're doing here at NCC, programs that CACLV does, and the small business centers that people learn how to take the time to educate themselves on how to really do the basics on putting a business plan together that defend and with financial estimates sort of defends their thesis. Because without that and having not taken the time to study it and learn it, no one's going to fund you.
Great. So here's another question, Mike. So what excites you about innovation happening in the Lehigh Valley right now?
Well, if you come back to 1987, it was a dark time when Ben Franklin sort of was just getting started and they were looking for companies to come to the Valley and be part of a process to rejuvenate, industries that were being lost in the Lehigh Valley at that time. You fast forward today and you ignore the coronavirus sort of weirdness today. It's just an exciting, period in time. Whether you're Allentown, Bethlehem, or Easton, all three of them, they're just economic activities and redefining each of those communities, both in economic development and social development and destinations that I think is extraordinarily progressive. And I just think it's an exciting time for the Lehigh Valley at multiple levels. It gets a little confusing when we also, besides all that, those things that are going on, those particular projects, that we become this distribution hub. There's a lot of trucks and a lot of hassles with that. But because of our proximity, and I'm the chairman of LVIP, and I've been on that board for longer than I'd like to admit, but probably 18 years or something like that. We are now a distribution and logistics hub for the eastern part of the United States. So overall, I think it's a real exciting time. I think there's endless opportunities on different fronts, and the Valley's never had a more diverse base of good activities going on than what we have right now.
Okay. Here's the next question for you. I realize it's early to formulate a strategy, but what advice do you have for small businesses in today's coronavirus war?
Well, you know, if people are at home right now and they've got time to put their business plan together and put together some pro forma financial statements and be able to package it up in terms of a you know, a presentation and in a pitch format, they can do a lot of things at home that otherwise business and other things would noisy get in the way. So I think for an early entrepreneur, doing that front end framework is, you know, there's this window of time that they've got now that you can use it, or, you know, or just goof around on it. So I think I think that window of time is there. You know, it's every business is different for who needs what kind of capital for what reason. So, Raj, I don't know how to simplify, you know, where do you go right now? If you're existing businesses, the SBA has got emergency loan funds. But if you're looking for sources of capital anywhere else right now, they're on shutdown mode. Everybody's on shutdown mode for 2 or 3 weeks. So I think all you can do is be prepared with your best product to put in front of people and hope we can come out of this where doors are open to do business in the next 30 to 60 days.
Okay. No, I think that's right, Mike. I think that's a tough question to answer right now, but I love your comment on the fact that probably this might be a good time to really work on your plan, you know, and then put it together. You know, that makes sense. There's a question regarding your involvement with social entrepreneurship. I think the last slide that you put on One Putt Ventures mentioned about you're also now actively being engaged in social entrepreneurship. So the question is, can you elaborate more on what you mean by social entrepreneurship? What would the outcomes look like?
Legacy projects is sort of important to me. I mean, there's always a term of time, talent, and treasures. I now, and as I've shifted out, it's sort of, you know, we still have 4 companies left in our portfolio for Originate. I'm on the board of 2, and I'm on 2 outside boards. But relative to my demands on my time, they aren't the same. Big things for legacy for me, LVIP, you know, we're 60 years as a land development company. We're developing the largest brownfield site in the country with 1,000 acres of reclaimed Bethlehem steel property on Route 412. We have a balance sheet that gives us opportunities to do parks 8, 9, and 10 if we want, and we're actively looking to do those over the next, you know, call it 5 to 20 years. So legacy projects in terms of economic development and infrastructure in real estate projects that LVIP does, which we're always the developer of last resort because we do difficult things others can't do, is right in a sweet spot with working with Carrie. It's phenomenal. And the board that we have there is very active economic development people like myself. And that's completely energizing. Otherwise, you know, I have one-off projects that'll come and go all the time that, either is I'll give some guidance, I'll give some capital to, but it's all passive instead of active.
Okay, so I'm going to jump into a question here because I think it also relates to your your current fund here, the One Putt. Question is, do you consider One Putt to be industry agnostic? If not, what are your industry interests, if there are any? And I'm assuming that the focus is the Greater Lehigh Valley.
It's still defining itself. I don't want to be in the consulting business. I'm not an hourly guy anyway, so I can tell you what it's not. I'm going to put a certain amount of my own personal capital to work, and I'll bring other investors in if there's a deal that I like. I'm not actively looking for them. It's public knowledge that last year, Cryo Concepts repurchased the Histofreezer business from OraSure for $12 million. Somebody called me and said, "Hey, Mike, I can't believe you're not involved with that." And I said, "Well, I kind of was behind the scenes. The guy put the $15 million financing, which was $12 million in cash for the acquisition and then $3 million for working capital to grow the company." Embassy Bank would step up big for $6 million of that 15. And then I did private placement of $9 million in less than 30 days. But this was with former founders of OraSure that I'd been with. And I was a leading investor in that. But I put that capital together and 2 other smaller projects I'd mentioned. With entrepreneurs that have a bias to You call it sort of not early stage equity, but for me was, cash flow driven businesses that needed, you know, uh, bridge financing on a small scale. But one-offs, just I get excited by entrepreneurs that have a good model. But mostly I'm trying to, I'm building a house in Asheville and I'm trying to hit a golf ball straight and I want to, bike more than 1,000 miles. So those are more important to me. And I'm happy to meet with people individually to help them think through things, but I'm probably not the source of capital for them for the deals. If anybody wants to sit down with me, that's kind of what I tell people now. But then I'll do deals if I want to.
Okay. Here's another question for you. Do you have any thoughts as to whether it is preferable to be a nonprofit or a B Corp when the work falls into the social entrepreneurship category?
Well, if it's my own money and, I can decide whether I want to play on the for-profit and try to get a big return and then give a portion of that benefit to my philanthropic activities, or whether what I'm investing into is for the betterment of society and I'm going to take a tax write-off from the day I write the check. I don't think that somebody should go out and ask for investors for a nonprofit. I think and that's not something I personally would find interesting or to ask investors to be in, because, I'm a capitalist and I, typically want to generate a cash on cash return north of 10 or 15% annualized. And that's not what you do for nonprofits. But you do it for the bigger good. There's for those that know me, when my wife died, there was a perfect storm. We were in a capital campaign for the Second Harvest Food Bank. We didn't have a leader of that, and we were at a stall pattern. And I ended up giving a substantial gift, and it opened up a little bit of a domino effect. And the Second Harvest Food Bank physical building is called Sharon's Pantry, after my wife. And that was a large gift to help feed the 6-county region. We do not meet, even with 9 million pounds of food that we deliver, between 9 and 10 million pounds of food, the food that they distribute. We're only meeting less than half the needs for those below the poverty line for food. So that's a big legacy project for me that I still will financially support regardless of where I am.
Okay. Here's a question actually from one of our students at NCC. So the question is, what is the Lehigh Valley's current outlook for developing spaces for alternative medicine or adding alternative medicine services?
I have no idea. I don't know anything about alternative medicine that way. My closest thing to alternative medicine is going for a bike ride or playing golf or trying to taste new bourbons. So
okay.
I don't know that answer.
Okay. So the next question here, how can you estimate value? How can you value a startup during a pitch to investors that is pre-revenue? And the second question is, would you consider hosting a Shark Tank local event that looks at companies that are not high tech?
So the two questions. It's a great question, the first one. I'll tell a quick story here. We were written up in the morning call, and I knew we wanted to raise money locally, but in the old days, everybody read a newspaper in 1987, 88. And a guy named Ray Holton, who's over the years become quite a good friend and served on a couple boards with him. He was the editor of the Morning Call and wrote an article in the business section and the front page on the left side about sort of the startup company that had a sunscreen product on a towelette delivery system. We got bombarded with calls the next week, kind of people, wanted to offer services, and a couple people wanted to put money in. And literally an investor said, he wanted to do consulting. And I said, he said, what do you really need? I said, I need money. And out of nowhere, he said, if I could raise $300,000 at a $3 million valuation for your company, would you let me do that? And I couldn't pull my hand out fast enough to shake his hand and say, sure. And so the first valuation to start our first business was done because somebody was trying to sell me services and threw out a number that I thought was crazy high. I shook hands and then proceeded over the next 6 months. He made introductions for me to pitch. And it would always come up, how'd you come up with a $3 million valuation? Well, I could spin, what our potential future revenues were, but it all had to do with a handshake when we knew nothing about each other's businesses, number one. Number two with that is every pitch that we had, we listened to investors or potential investment opportunity for our venture fund. And we listened to 250 or 300 companies do presentations over the 10 years. Our last question almost always was, if they had come in to see us, what valuation you put on your business. And if they would say, I don't know, it's negotiable, then that means they're clueless, that they don't understand how to run their financials. Why are we going to give them our money when they don't even know how to, confidently, aggressively, almost cocky sort of say what their business is worth. So that was almost a non-starter for us if people said, I don't know, because that just meant they didn't get financial stuff at all. And that's a gross simplification, but directionally correct. The other side is our sweet spot on almost everything is we were going to do something, regardless of who we were investing in, it's somewhere between a $3 and $4 million valuation. Because if we were going to put 2 or 3 million in, we really wanted, in a perfect world, to own between 20 and 30% of the company. So our discipline was around a $3 to $4 million pre-money, with us putting $1.5 million to $2 million in. So so in the example of if the value of the business is 3 million and we put in $1.5 million, we own 33% of the company. That would have been an ideal model for us to start, because everybody diluted later on. So we had a definition where we like to play for early stage technology companies, and we really didn't sway from that much. If somebody came in and said, my business is worth 15 million, we go, well, good luck with that. That's not us. You'd find one of two things would happen. Either they go, well, I don't want to lose this deal. I'd come down a little bit. And maybe you had a negotiation there, but you kind of go, one of my partners or I would go, we're not going to do a nickel above a 4 million pre-money. So you're either wasting your time, but if you're there, we're interested in what you're doing. And we'd either quickly it either disappear or there'd be a discussion. Just give an ultimatum where we were, but it ultimately was about discipline on the kind of investments we did. You need to be very clear. If you spend the time doing your homework, frame up your business plan, it's going to say what your use of proceeds are, and it's going to say what you're going to get out of that. And you need to be able to say, I need $100,000 for a small business. I need $100,000. I'm willing to give 15% of my company. And this is what I'm going to do with $100,000. This is how I'm going to spend every one of those dollars. And if you can articulate as a very small business, what you're going to spend it for, at a minimum, I don't know whether I'd invest or not, but I would tell you that's really impressive. You know exactly where you're going to spend your money and what that use of my proceeds are versus somebody said, trust me, I'll spend the 100,000 really well, versus a very specific use of proceeds.
Okay, great. So next question here. Mike, have you thought about bringing in some younger people and mentoring them, as you have a lot of knowledge?
Younger people in what respect?
I'm guessing here, but I'm thinking college students, other entrepreneurs that probably have just started, their business, or probably wants to get into something. They probably have a job, they left it, they want to start their own company. I'm assuming that's what the question is about.
Selfishly at this stage of my life, I am shifting to a bias of retirement, not sign, because I've been told by a bunch of my friends, no way can Mike go without working. All right, so that's why I did one putt. And because of the success of our venture fund, I think I could raise $10 to $20 million more and do this all over again. We're not done yet. We had started in 2007 and we're now going in 2020. So it's 13 years later, and we're probably 3 years from getting out of the rest of our portfolio. So I'm 16 years and I'm, at 62, I'm not ready to sign up for another 10 to 15 years of the level of commitment that I have when I take investors' money. So I'm not going to do this again because my obligation to the investors, I don't have that desire to commit that much time and that much of my life effort. I've been obsessively, compulsively, you don't get the results we got without sort of being obsessed and doing this, about 99% of your breathing time. I think I was a good family man. I think I went home when I wasn't working, but I worked all the time. So I just don't want to do that again. So, I can mentor, do one-off deals on stuff I like, but I don't want a 10-year commitment again. Not now.
Okay. But you are open to mentoring younger generation?
As long as it doesn't become a fatal attraction.
Got it. So next question here. You describe yourself as a capitalist and mention your work with Second Harvest. What's your response to Larry Fink's, I'm assuming that gentleman through the BlackRock, recent message about sustainability, ESG, and valuation of fossil fuel industry going forward?
Again, I'm not a fossil fuel expert by any means. We definitely have environmental issues that are going on that the government has to show leadership with to be responsible citizens. At the time you find the balance between, oil exploration and energy exploration. I can tell you that I've lost my shirt making investments into, limited partnerships that have a bias towards oil. And they've been particularly crushed lately. I don't think it has anything to do with about environmental, conservation. I think it has to do with the head of Saudi Arabia personally fighting with Putin in Russia. But, I guess where that shows up as a risk factor. So as an investor, it's Exxon has dropped 60% in value. That whole category of oil pricing is now going to all-time lows, or going back down to all-time lows. And unfortunately, that puts a real burden on going to alternative fuel sources when people are making oil so cheap. You just can't afford to make that change quickly unless the government intervenes. So that's a complicated topic that I don't have a banner on. But we gotta be responsible in many, many ways on that topic.
Okay, good. I think I believe that was the last question. And by the way, timing is perfect. I think it's about 8 minutes till 10. So before we leave here, a couple of quick housekeeping items. Mike, first of all, thank you for doing this, for us, and then you are our experimentation today, and then our goal is to continue this in the future as well. So for those of you that are still online, for our next 1 million cups presentation, it's going to be through Zoom, because the call is technically, we are working from home for at least the foreseeable future, and we have been advised that we are following the CDC guideline. So the next 1 million cup would be online. So just keep that in mind. We will be sending out Zoom information again for next week's presentation. Our next week's presentation is Kevin Campbell, who's the president and CEO of Barry Eisen. Another thing that I'd like to mention to you, that this session is recorded, so we are recording on our Zoom session, so I'll make that available as well. And what I can also do is that I have gotten Mike's presentation, and Mike, I don't think you'll have an issue for me to share that presentation.
No, I said earlier both that and somebody wants to meet one-on-one, I'd be happy to do so.
Okay, that's great. So I'll be sending out the presentation as well. So stay healthy and stay safe, and we'll talk again next Wednesday. Thank you.